What if the stock market's worst days were actually your biggest opportunity? Every time the market drops, millions of investors panic and sell, but long-term investors see something different: stocks on sale. Value investing for beginners starts with one simple idea. Great companies sometimes get priced like they're in trouble, even when they're not. As Benjamin Graham, the father of value investing, once wrote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." So, how do you find undervalued stocks before they recover? Learning a few stock valuation basics is the first step. The first tool is the PE ratio, or price-to-earnings ratio, which tells you how much you're paying for every dollar a company earns. A lower PE compared to industry peers can signal that a stock may be trading below its true value, though context always matters. But the PE ratio alone isn't enough. That's where price-to-book value comes in. Price-to-book compares a company's stock price to its net assets, helping you gauge whether you're buying a business at a discount to what it's worth on paper. The third metric every beginner should know is free cash flow, the real money a business generates after expenses. Strong, consistent free cash flow is one of the clearest signs a company is financially healthy, even when its stock price doesn't reflect it. As Warren Buffett has said, price is what you pay, value is what you get. Now, here's the critical question. Why do stock sales happen in the first place? Sometimes it's a broader market dip, a short-term earnings miss, or negative headlines that have little to do with a company's long-term fundamentals. Those are the moments long-term investors watch for. But not every cheap stock is a bargain. Some are cheap for a very good reason. Red flags typically include shrinking revenue over multiple years, rising debt with no clear path to profitability, and management that consistently misses its own guidance. A low price means nothing if the underlying business is deteriorating. Peter Lynch, one of history's most successful fund managers, warned about the value trap, a stock that looks cheap but keeps getting cheaper. The goal isn't to find the lowest price, it's to find the best value at a reasonable price. Combine solid valuation metrics with a business you actually understand, and you have the foundation of a disciplined, long-term investing strategy. Stock market basics like these have helped investors build real wealth over decades, not by chasing tips, but by thinking like patient owners of real businesses. If this breakdown helped you invest with more confidence, subscribe for more clear, practical investing content, and like the video if it was worth your time.